Let's start with the liquidation data because honestly, this is where the fireworks come from. According to Kaspa Daily, there's more than $30 million worth of short positions stacked above the current price level. These aren't scattered randomly. They're concentrated around the $0.064 zone. Why does that matter? Because shorts are leveraged bets against the price. Traders borrow KAS tokens, sell them at current prices, and hope to buy them back cheaper later. The profit comes from that price difference. But here's the risk. If price moves against them instead of with them, they get liquidated. Their positions automatically close, forcing them to buy back the tokens they sold. And when you have $30 million in shorts all clustered at the same price level, that forced buying creates a cascade. Here's how the domino effect works. Price pushes slightly higher toward 0.064. The first wave of shorts hits their liquidation threshold. Their automated buy orders execute, which pushes price higher. That triggers the next wave of liquidations. More forced buying. Price goes higher still. The cycle, really feeds on itself until all the over-leveraged shorts are cleared out. We've witnessed this pattern repeatedly across crypto markets. Bitcoin experienced it multiple times during its 2021 run. Solana had a brutal short squeeze in early 2023 that took it from $20 to $35 in just a matter of days. The mechanics are always the same. Overconfident shorts pile in, bulls find a catalyst. One breakout candle triggers the liquidation cascade, and price goes vertical before anyone even realizes what happened. Kaspa is currently sitting just below that critical 6.4 cent zone. It's hovering in the danger zone for shorts, close enough that a moderate buying push could start the chain reaction, but far enough that shorts still feel comfortable holding their positions. That's really the sweet spot for a squeeze. So, shorts haven't panicked yet. They still think they're safe, but the moment price crosses that line, well, safety just disappears. The beautiful thing about short squeezes is that they're self-fulfilling. You don't actually need massive fundamental news or whale buying. All you really need is enough momentum to reach the liquidation threshold. And once you're there, the forced buying does the heavy lifting for you. Price action becomes disconnected from fundamentals, at least for a brief period, because liquidation algorithms just don't care about valuation. They simply execute orders, nothing more. That's why, experienced traders watch liquidation maps closely. It's not about predicting price based on fundamentals or sentiment. It's really about identifying where forced buying or selling will occur based on leverage concentration. Right now, Kaspa has a massive concentration of forced buying, just waiting to activate at around 6.4 cents. That makes it, honestly, one of the highest probability setups in the market. The psychology here is also, pretty fascinating. Shorts entered these positions believing Kaspa would continue lower. They're banking on weakness. But if price breaks above their liquidation levels, they actually become the fuel for the rally they bet against. That irony is what makes short squeezes so explosive. The very capital betting on downside becomes the ammunition for upside. Before we get into the Wyckoff pattern that confirms this setup, smash that like button right now. This liquidation analysis is information most traders won't see until after the squeeze happens, and if you're not subscribed to TJ Crypto World, fix that immediately. We identify these high-probability setups before they play out, not after everyone's already bought. Turn on notifications so you're first to know when Kaspa breaks that $0.064 level. The Wyckoff accumulation pattern. Now let's talk about why the chart structure makes this short squeeze even more probable. Kaspa Daily identified what appears to be a Wyckoff accumulation phase forming on the daily time frame. If you're not familiar with Wyckoff, it's one of the most reliable patterns in technical analysis, and honestly, it's been around for over a century because it works. Here's how accumulation phases develop. After a prolonged decline, price enters a range where it moves sideways. The casual observer sees boring consolidation. But what's actually happening beneath the surface is smart money absorbing supply from weak hands. Retail sees the price going nowhere and sells out of frustration. Institutions quietly buy that supply without pushing price up too fast, which would attract attention and competition. The accumulation phase has specific stages. First is the selling climax, where panic selling exhausts itself. Then comes the automatic rally as the easiest sellers are cleared out. Price pulls back again in what's called a secondary test, confirming that selling pressure is diminishing. This back and forth continues as smart money accumulates. The critical moment comes with the spring. This is a false breakdown designed to shake out the final weak hands and trap late shorts. Price drops below the established range, triggering stop losses and creating fear. But instead of continuing lower, it reverses sharply. So, that failed breakdown actually signals that sellers are exhausted and, buyers are just about ready to take control. After the spring, there comes the test. where price returns to the breakout level just to confirm that support has really been established. Once that test holds, the markup phase begins. This is when price stops consolidating and actually starts trending. The sideways range transforms into an uptrend, and honestly, it often catches traders off guard because they got so used to the consolidation. So, looking at Kaspa's chart right now, the structure suggests we may have already experienced the spring. If that's the case, and Kaspa Daily's analysis really supports this interpretation, then we're potentially entering the early markup phase. That means, the boring consolidation is about to transform into a sustained uptrend. The timing alignment is what makes this so compelling. We have a Wyckoff accumulation pattern suggesting smart money is positioned for upside. There's $30 million in short liquidations concentrated at 6.4 cents. And honestly, we have price sitting just below that threshold. All three factors point in the same direction. Upward volatility incoming. The Wyckoff pattern also explains why price might consolidate a bit more before the breakout. The test phase after the spring can take time. Smart money wants to ensure the foundation is solid before pushing price higher. Impatient traders see this final consolidation and assume nothing's happening, but that's exactly when the setup is ripening. If this pattern continues playing out as expected, the target range becomes clear. The markup phase typically retraces a significant portion of the previous decline. For Kaspa, that projects targets in the 7 to 8 cent zone. From current levels around 6 cents, that represents about a 15 to 35% move. Not life-changing on its own, but when combined with short squeeze mechanics, the move could happen in days rather than weeks. So, why is the setup clean? Let's connect all the pieces and understand why traders are getting increasingly bullish on this setup. The alignment of factors creates what technical analysts call confluence. Multiple independent signals pointing toward the same conclusion. Okay, so factor 1 is liquidation pressure. There's actually over $30 million in forced buying just waiting to activate. And, this isn't just speculation about what might happen. This is real observable data that shows exactly where those automated liquidations are going to kick in. The moment price touches 6.4 cents, those orders are going to execute whether traders want them to or not. Now, factor 2 is Wyckoff accumulation. This is a century-old pattern that helps identify when smart money has finished accumulating and is just about ready to mark up the price. It looks like the spring has already happened, the test is underway, and yeah, the markup phase could be next. This gives the move structural support beyond just a short squeeze. Factor 3. Market timing. We're not in a broader market meltdown. Bitcoin isn't crashing. The macro environment isn't hostile to risk assets. Kaspa has room to move without fighting against overwhelming market headwinds. When conditions are neutral to positive, individual setups have a higher probability of playing out. Factor 4. Clean support. The consolidation range has established clear support levels. If the markup phase begins and price dips, there are defined zones where buyers should step in. That reduces risk for traders entering positions because stop losses can be placed logically rather than arbitrarily. The $0.064 level is the fulcrum of the entire setup. It's simultaneously the liquidation trigger for shorts, the breakout level for the Wyckoff pattern, and the resistance that's held price down. That convergence of factors at a single price point is what creates explosive moves. Markets don't move in straight lines, but when enough pressure builds at one level, the release can be violent. What makes this different from random hopium is the specificity. We're not saying Kaspa will pump because reasons. We're saying if price reaches 6.4 cents, these specific mechanisms activate, creating this probable outcome. That's predictive analysis based on observable data, not wishful thinking. The comparison to previous short squeezes on Bitcoin and Solana isn't coincidental. The mechanics are identical. Overconfident shorts, clustered liquidations, a technical pattern suggesting accumulation, and a clear trigger level. When these elements aligned for Bitcoin and Solana, the results were explosive. Kaspa is showing the same setup. If this Kaspa short squeeze analysis helped you understand what's developing, hit that like button right now. Share this video with traders who need to see this setup before it triggers. And subscribe to TJ Crypto World if you want analysis that identifies high probability moves before they happen, not after everyone's already talking about them. So, where does this leave Kaspa right now? The setup is clean. Over $30 million in short liquidations clustered at 6.4 cents, a Wyckoff accumulation pattern suggesting smart money has positioned for markup, support established, macro conditions neutral to positive, and price sitting just below the trigger level. Does that guarantee Kaspa pumps to 8 cents tomorrow? Of course not. Markets don't work that way, but it does mean the probability of upward volatility is significantly higher than downward. The risk-reward favors bulls, the mechanics favor a short squeeze, and the pattern favors continuation of the accumulation phase into markup. As Kaspa Daily correctly stated, the market doesn't reward impatience, but it does reward conviction. This setup could take a few more days to mature. The test phase of the Wyckoff pattern might require additional consolidation, but once that $0.064 level breaks, the move should be fast. Short squeezes don't give you time to think. They happen in minutes and hours, not days and weeks. For those positioned, patience is the play. For those watching, the entry level is clear. For those short, good luck. Because when $30 million in liquidations cascade, positions get closed whether you're ready or not. Thanks for watching TJ Crypto World. If you want to see how we're tracking other altcoins with similar short squeeze setups, check out our video on high leverage liquidation zones across the market. It's linked on your screen right now. I'll see you in the next one. Stay sharp, stay positioned, and never fight against liquidation cascade.